We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Michael Gentile, strategic investor in the resource sector and former institutional money manager. How are you today, Michael?
Hey, Tom. Great to be back.
Excellent to have you back. So as we saw at the tail end of last week there, Powell came out and was quite dovish despite having many reasons to taper. So from your perspective, was this a signal to the market that the Fed is trapped and won't be doing anything meaningful in the form of tapering coming soon?
Yeah, I think it was yet again another illustration of how much inability the Fed has to act in their current predicament. I mean, I've used this analogy in a previous interview I did a couple of weeks ago, but if you're a Martian, you came down from Mars and landed on the planet Earth, and you said that inflation was running at 6-7%, unemployment was at 5.6, GDP was running between 6 and 7% growth, and that you were tapering by buying 120 billion of bonds and interest rates were at zero, you'd think you're crazy, right? So that just shows you. I mean, the Fed is way behind the curve. There's no reason to have the amount of tapering that we have going on right now and have 0% interest rates. So the fact that yet again at Jackson Hole, they deferred for another couple of months, even to start talking about when they're going to start to taper, to me shows you how truly trapped and how unable they are to act in the current situation.
So what, in your opinion, could actually drive the Fed to start to taper their printing program or raising rates here?
Yeah, like I said earlier, they should have been moving months ago. I mean, rates should already be above zero, in my opinion, significantly above zero in a normal world where they had the ability to act. So what I think eventually they're going to have to choose between losing all credibility. I mean, a lot of people's eyes, like myself, they've lost all credibility already, but in the eyes of the general public, they still think the Fed is going to, act in a traditional rate rising cycle. So I think if you see another 3-4 months of inflation clicking above 5%, I think between now and the end of the year, they have to at the very least announce that they're going to start the tapering process and give a timeline to exiting the tapering process. I think if they don't do that by the end of the year, I think the market, they're going to lose all control over fiat money, and the market is going to give them zero credibility going forward. So I think that's the timeline. Should they be acting sooner? Yes. Will they do it? Probably not. We can get to that a bit later in our discussion, but that would be my prediction. Next 3-4 months, they're going to have to outline a pretty concrete case to at least start tapering, and maybe potentially even, scary to say, when the first rate hike would potentially happen in that time frame as well.
Mm-hmm. Yeah, and as you're saying, if inflation continues at this rate, that really destroys their transitory narrative, right?
I mean, they've already switched to what they use transitory to, I don't know what the word they use in the last statement, I'll have to dig it up, but they've already sort of slowly adjusted the language. I mean, you can't call 6, 7, 8, 9 months in a row of inflation running well above your target range as transitory. Mm-hmm. I know you used this analogy before as well, but I have a friend of mine who runs a business locally here in Montreal, and it's a bread manufacturing business. They supply grocery stores and restaurants and hotel chains with bread. They used to pay their workers $14 an hour. And if you look at today, they're advertising $22 to $24 an hour, and they cannot find workers to fill their jobs. So you and I both know once you get a raise, very, very hard to walk that back. And you definitely can't use the excuse when you're cutting your employees' wages that was just transitory inflation that we got to readjust. So these price increases, they're very sticky and they last a lot longer. And once that mindset gets in people's heads, the prices are going up and my wages are going up and I need to make more money to pay for my groceries, it's very hard to put that genie back in the bottle, especially when you're pumping the system with so much free money well above what the system requires. So I think it's going to be hard for them to pull that transitory narrative back in the future.
So when we have, let's say, asset or commercial good inflation coupled with this wage growth, as you're pointing out, this seems like a normal inflationary environment. But there's been past guests of the show that are saying that we're headed more towards a stagflationary environment where, let's say, average wages aren't actually growing. So do you see that trend continuing? And if so, how does that really play with this inflation narrative of or just going forward?
Yeah, there's a few things. So I'd say you have to look at what's causing inflation. Just to really keep it really simple for your viewers, the last 12 to 24 months, we've printed anywhere from kind of 25 to 40% of all dollar bills in the existence of the United States history in the last 12 to 24 months, right? So you've increased the amount of bills floating around or dollar bills floating around by 25 to 40%. And if the amount of goods in the economy are fixed, just that alone you would see price increase just based on common sense, right? More dollars sloshing around. Then you add to the fact that the government's been, pumping tons and tons of money into people's pockets. So driving spending, kind of driving demand that artificially would not be there based on the productive capacity of the economy, right? So those guests who talk about stagflation, that is a real possibility, because when you pull the stimulus back, both the Federal Reserve punch bowl, but also the checks the government's telling people to stay at home and not work, and the support for businesses and restaurants, all that, basically paying businesses to stay open that otherwise would have gone bankrupt or closed in a normal functioning economy. Mm-hmm. When you pull that away, the money printing presses have to continue to sustain these unsustainable debt levels that we've printed as society, but the demand will drop off because you stop giving people free money, they're going to consume less, right? So that's a stagflation argument where you're devaluing your fiat currency, you're printing lots of dollar bills, which are increasing the prices of everything, but your actually economic recovery has been a bit of a mirage the last 12 to 24 months, right? Because you've been basically just pumping mass amounts of free money, both from the Federal Reserve and taking on mass amount of debts to keep things going that otherwise wouldn't have gone. Once that's removed, your economic growth is going to slow down. It's not like we dramatically increased the productive capacity of the economy, or we've had major innovations that's created new growth or new dynamism in the economy. We've just basically been pumping money to keep the patient alive. So that is a very real possibility, Tom, of a lower growth, higher inflation environment going forward, which is really a very terrible recipe for the stock market. If you add those two things, if that comes to pass, that'd be a very negative outcome for the market.
Absolutely. And as you point out, the economy and the stock market are very disconnected, and they're not the same thing, but everybody looks to the stock market as an indicator of this quote unquote recovery, as you put it. So, Michael, you were kind of pointing out that we might see, basically a deflationary period if we get these slowdowns once the market, let's say, realizes the inefficiencies that have been created here, let's say. So do you foresee deflationary periods as part of this longer term cycle that we're going to see play out here over the next couple of years?
So there's a few things. I mean, so one, I'll answer that question two ways. One, yeah, there are deflationary forces in the backdrop, which is technology, right? Mm-hmm. I mean, that productivity is eliminating the need for labor constantly, and the innovation industries are reducing the amount of work required to produce the same amount of goods. So that is a major deflationary force in the backdrop. Second deflationary force is the huge amount of debt that we have in our country and globally, right? Because that just suppresses rates, does not allow rates to go higher, allows the government to intervene, having the force of the government to intervene constantly in the economy, control more and more of the economy to keep this boat afloat, so to speak. That also has a high deflationary force. The other way I'd answer that too is in the shorter term, 2022 and 2023, what I'm looking at from the market perspective is that a lot of these stimulants that we've been receiving in 2020 and 2021, so the Federal Reserve, the government spending, that's going to start to decelerate in 2022. The amount of government checks and intervention in the economy is going to be significantly lower in 2022 than it was last year, than it was again in 2020. The amount of comparisons that you have as the economy's recovered, you're comparing 2021, if you look at earnings that look fantastic in 2021, right? Because you're comparing to an economy that was basically in lockdown. So revenue growth 50, 100%, earnings growth up 200% because your comp from the year before was zero activity, right? So those comps 2022 and 2020, now you're comparing a normal year to a normal year, 22 to 21, 23 to 22. So that's going to look a lot less exciting. So you're going to see this natural deceleration in the economy, both from lack of stimulant and also just from harder comparisons going forward, which is also going to give the impression of a slowing and decelerating economy. In the backdrop where the Fed is so behind the curve, they're going to have to be raising rates or removing stimulus into that backdrop. That's a pretty dangerous tightrope to walking across when you have the economy likely decelerating and the Fed removing stimulus at the same time. That's a kind of train wreck waiting to happen, in my opinion.
Mm-hmm. So as you mentioned this debt, Michael, if we look at who is buying US debt, can this be another indicator of how the world sees the favorable return on investing in treasuries right now?
You use the word favorable. I'm going to put that in brackets, right?
Relatively favorable.
Yeah, I'll use the word less terrible, or the best house on a terrible block, so to speak. Mm-hmm. So first, let's look at who's buying the debt. I don't have the exact numbers in front of me, but let's say in general, the last 12 to 24 months or longer, 25 to 40% of all federal treasury issuance has been bought by the Federal Reserve. So you have basically a manipulated market, or not a free market price discovery market in treasuries. You have your Federal Reserve buying the majority of the debt that's being issued, the last 12 to 24 months. So that's one. That's why rates are where they are, why they're so low versus where they should be. If you remove the Federal Reserve as a buyer of that debt, which they should not be a buyer of that debt in normal times, rates would be significantly higher. And maybe you'd attract people like myself and yourself to buy treasuries. At a 1% or 1.4%, 1.35 10-year treasury yield today, you have negative real returns from a 10-year bond. Inflation is running at 5 or 6, and the treasury is running 1.3 to 1.4. So to buy that treasury, you're signing up for a negative real return in the next 10 years. You have to think either inflation is going to collapse or you're happy to earn negative real returns. Why are people buying that? Because other sovereign debt options are yielding even less and are even less desirable than the US government bond issuances. You have more unstable countries / fiscal regimes yielding lower yields. So it's basically like the worst house on a bad block is the treasuries, but the entire bond market is completely manipulated and suppressed by the record level intervention you've seen by the federal central banks globally in that market. So it's hard to say. I mean, who's buying it? Bond managers that have to buy the bonds and trying to earn a relative return versus a benchmark, people that are hoping the Fed continues to buy more bonds and you make money because the Fed continues to intervene. But I've yet to see a coherent argument on why a 10-year treasury at 1.4% when inflation is 5% is a great long-term investment for your viewers. And you're literally signing up for a negative outcome. Let's not talk about the high yield bond market, which looks even scarier to me, but in that bond market right now, you're signing up for pain unless you're playing the relative game, which I'm going to lose less money than my other portfolio manager, or maybe make more money because the Fed will have to intervene even more significantly in the future.
And as we talk about this, let's say relative strength here or there, I'd like to take a bit of a wider lens to that. So if we're looking at the US dollar, let's say the DXY, it's measured against this basket of other currencies that are similarly being devalued. So how do you see the longer term picture for the US dollar playing out?
Yeah, it's the same analogy. It's probably one of the better houses on a terrible block because every kind of significant economy in the world is playing the same game, right? Print, control your bond market, keep rates close to zero or negative over time. So yeah, you're right. When you look at the US dollar, the call for the US dollar to collapse will really be a relative trouble issue, right? The amount of debt in the US and their ability to finance it and the need for more intervention, easy money policy in the US versus the other countries, currencies in the world. So that's why I'm so bullish on gold, right? Because if everyone is printing and effectively increasing the amount of paper money of their currency in circulation, gold is a fixed currency. It's fungible, it's liquid, it can be transferred globally and effortlessly. So as those currencies are producing more and more paper, the value of gold on a relative basis to all the currencies in the world should increase dramatically. And I think that's what we're going to see. And we've seen in the last few years, but we're going to see even more of that in the future. So it's hard game to predict, is the US dollar going to outperform the Canadian dollar, the Japanese yen, over time. But I know for certain they're all playing the same game. They're all devaluing their paper currencies. I mean, Ray Dalio's done some amazing work on fiat currencies over hundreds of years, and most of them have devalued by 95 to 99% over time. That is the end game for all these currencies. What you're seeing now is just a dramatic acceleration of their demise. As you press on the gas pedal as hard as they are now, you're just accelerating the devaluation of those fiat currencies. I think that's where gold and hard assets will shine, because they'll be able to shine a light on that massive devaluation you're seeing on paper currencies globally.
So you mentioned gold there, Michael, and the last time we spoke was in March, actually. And I was just wondering if the let's say the fundamental backdrop for the metals has only improved since we last spoke.
I mean, I'd say that on the equity side, I'm as bullish as I've ever been on the space. I started getting interested in gold in 2015 and 2016. When gold was sort of $1,100 an ounce and literally nobody cared about it. That was a great moment. As a commodity investor, you typically want to invest at those pain points when people have kind of given up all hope for a commodity. But I'd say right now, Tom, that the equities are incredibly interesting here. And I can walk you through my thesis. If you look at gold 1,800, I think it has good potential to move significantly higher. Gold versus the S&P 500 is trading at multi-decade lows, or very close to multi-decade low valuation. So you can buy more gold with one unit of the S&P 500 than you have been able to buy for many, many years. So gold is very undervalued as an asset class versus the market. And we've talked about why the market is constructively overvalued, I think, based on these low rates. Mm-hmm. But then you look at the gold stocks themselves, look at proxy of GDXJ or GDX. Both of these indexes of small gold producers and large gold producers are trading at record high spreads to the price of gold. So the other day I looked at GDXJ, it's trading about 20% below where it typically trade when gold is $1,800 an ounce. So if you follow the logic, gold is at a record discount to the market. So gold is cheap, but the gold stocks themselves are trading at 20% discount to where they should be if gold is 1,800. So that's providing, a huge, I think, opportunity. I think gold is one of the most undervalued asset class in the market today. In a market where everything is dramatically overvalued, gold is undervalued, and the equities are even more undervalued versus the price of gold. So that, to me, as a contrarian investor, as an investor who likes to look for those type of opportunities, is very exciting. The second part of that, why gold equities are attractive, is that they're generating record cash flows. This industry has gone through a major cleanup from the last bull market, where a lot of gold companies got over their skis and got a bit too excited and did a bunch of M&A and got their costs way out of control. From 2008, 2012, it was a big boom, and then the bust happened in 2012. And these companies spent 7 to 10 years cutting costs, rationalizing their operations, selling underperforming assets, focusing on returns, paying dividends, generating free cash flow, generating real return on capital. Look at the industry today, Tom. The gold industry is one of the most profitable industries on a free cash flow basis. It's the only industry trading with a free cash flow yield higher than inflation today. So every other industry I've looked at, their free cash flow yield is less than the rate of inflation. Gold is above that. So you got great fundamental value from a bottom-up institutional investor perspective, and you've got a great relative value proposition, both from the gold equities and the gold price itself versus the market, and nobody cares. So that to me is the trifecta of how you make a lot of money in the market, because as investors come around to that thesis and realize the value there's a lot of room for incremental buyers to come into the gold market, both equities and physical.
You mentioned there, Michael, that nobody cares right now. And I was just wondering if you think that the crypto space has taken some of the speculative money away from gold and silver. And do you see this crypto space as being much more, let's say, fragile than most investors think?
I would say the crypto space or the massive speculation you're seeing in multiple corners of the market. So I'd expand that beyond crypto.
Okay.
Gold does really well as a store of value, as a safety valve in your portfolio. Not many people are going to be attracted to gold when they can make 100% in a day trading GameStop or American Entertainment movie theaters, right? So they're not going to be attracted to gold if they can make 20% trading Bitcoin in a day. They're not going to be attracted to gold when they can buy meme stocks or NFTs or wildly speculative early stage tech stocks and make hundreds of percent of money in a day. So when the market's as drunk as it is now and as exuberant as it is now, steady and reliable gold is not as exciting as your neighbors making tons of money on wildly speculative stuff. So the crypto market and all the other speculation you're seeing in the market is pulling away a bit of the luster from gold, no doubt. But that's very normal, very typical. If you look at typical gold market cycles, when the party's on, like in 1999, 90, 2000, 2001, gold was considered a relic. When people were making tons of money on .com stocks, nobody cared about gold. Nobody wanted to own gold. It was basically cast completely aside. And then when the party ended, starting in 2001, and the various crises that we had after that, gold went from $300 an ounce to $2,000 an ounce, right? So I think we're in that euphoric kind of stage where people are ignoring the value of gold. You mentioned what crypto space being more speculative than people think. I agree 100%. If and when, and I'm saying it's more when, the market crashes, the market comes down, I can't tell you when, but when that happens, you're going to see a lot of the speculative stuff like cryptocurrencies, the NFT market, tech stocks, high yield bonds. They're going to get completely annihilated. They're going to be down anywhere from 70 to 90% likely. And many of those stocks and currencies and asset classes will never recover because they're just full of speculation and leverage. That'll be the kickoff moment for when gold's only down 5 or 10%, typically what it does in a major correction. That's people are going to realize, wow, that gold really is a true store of value and a real value of my portfolio. And all that money flowing out of the hot sectors will move into that sector that's more sustainable and on longer terms over time. So that's kind of what you need, I think, to shine a light on gold's value. It's not a nice scenario, it's not a nice thesis, but I think we'll have to have some pain in the market for the value of gold to exert itself going forward.
You mentioned pain in the market there, Michael, and I wanted to get your thoughts around if the Fed actually does start to taper, if that starts to cause some of the pain that we're expecting to see. Does the Fed move back in right away and prop up the market if we do start to see 10+% losses in the general equities, or is it, are they basically out of tools to be able to recover a real drop, a meaningful drop in the general market?
Yeah, that's a great point. I would say yes. I'm surprised, Tom, to be honest with you, that the market is not more aware or pricing in more of that risk. So typically the market looks out 6 to 12 months into the future. And if you look out 6 to 12 months, only the most bullish person who believes that the Fed is completely willing to lose all credibility will tell you that they're not going to do anything in the next 6-12 months. So as they start to taper, 120 billion a month of bond purchases. We talked about why rates are so low, how they're intervening in the bond market. As that starts to roll down, the natural thing that's going to happen is that rates are going to start to move higher. And all these asset classes are trading at nosebleed record high valuations because they're priced off of 0% rates. So as rates start to lift off that 0-1% frame, the discount rate you apply to these highly speculative instruments are going to increase, and you typically see a dramatic fall in the price of these stocks. So my call is that the Fed is going to have a really hard time just getting from 120 billion and tapering down to zero, let alone raising rates for the first time. At some point in that path from 120 to zero, you're going to see a major train wreck. You're going to see the first shot in the market's going to be down 10, 15% as the market goes, oh shoot, the Fed is really serious about taking the punch bowl away. Mm-hmm. And then what does the Fed do when the market's down 10 or 15%, maybe 20 on the back of just tapering of bond purchases? Do they panic? Or do they continue? If they continue, the market's going to say, okay, here's another 10. We're down 30 now. What do you want to do, Federal Reserve? We're down 40. So as you get closer and closer to zero and closer to rate increases, the pain in the market's going to accelerate dramatically. And my call is they're not going to wait for very much panic because they're going to test the Fed and they're going to see, okay, you're really serious? And I just don't think the Fed has either the ability or the backbone to sustain that deceleration of tapering or get to rate hike increases. So yeah, that's going to be the moment when the market calls the Fed at the poker table and says, I'm calling your bluff. What are we going to do? My bet would be the Fed backs off because they can't afford for the bond market to implode. They can't afford for the equity market to implode. They can't afford to have that pain when you're running around with $30 trillion of debt that you're unable to service from normal means as a US economy.
Mm-hmm. So in that scenario, Michael, obviously the gold equities and gold will get pulled down alongside with this general market sell-off, just simply because of, let's say, margin calls, just needing liquidity in general. So how fast do you expect gold and the related equities to be able to bounce back from that?
Yeah, if you look at typical market sell-offs or crashes, Tom, you'll see markets down 50. I'd bet the cryptocurrencies are down 70 to 80. The more speculative stuff's down 80 to 90. And your physical gold price might be down 5 to 10% in that kind of true market crash scenarios. You're right. As liquidations come, margin calls happen. The gold equities probably be down 20 to 30 in that scenario because they're not over-owned, they're not over-leveraged, they're in a better position than the wildly speculative stuff in the market. But everything is going to be down as you properly identified. But what you'll see is as soon as the Fed makes the first move to re-intervene in the economy, gold price will rip back higher, probably within 2 or 3 months, maybe less of the Fed making their first move. The gold price will have regained all of its value loss, probably be even higher than it was. And the gold equities will also trade higher. But a lot of that speculative corners of the market may never come back because they weren't making money in the first place. They got completely crushed or over-levered, and therefore they just go out of business, or the investors are no longer willing to refund those businesses after they've lost 90% of their capital, right? They're licking their wounds. So that's sort of the playbook that I see happening, and to various degrees, a percentage sell-off depending on how aggressive the Fed is in their first move and how aggressive they are in telegraphing their future moves. But that would be typical for gold. And like I said, that'll show the market once the Fed reveals its hand and says we have to intervene here and to rescue the stock market. That's when gold probably makes new highs and doesn't look back after that, because then all the investors will be fully aware of how trapped the Federal Reserve is and their inability to normalize rates here.
Mm-hmm. As you've told me before, you're a generalist investor. You're not necessarily a real gold bug. So are there any other sectors of the market that have looked favorable to you at this time? I remember that in the 90s, you placed a big bet on oil, or are you just squarely focused on the metals and related equities right now?
I wish I could answer that question. Yes, that's part of the reason I'm not a 30-year gold bug who's always long gold and always loved gold and is bullish gold no matter when you call him or ask him. My big investment in gold is really more of a default position or a necessity, because I am a generalist portfolio manager. I look at all asset classes, real estate, bonds, equities, different things. The equity market, I'm struggling to find a single sector that is not overhyped, overbaked, and overvalued based on the Fed's actions and pricing in scenarios that I think are unplausible in the future. So the equity market mainly, to me, has been closed off. There's a few pockets of some commodities I can talk about with you in a second that I think maybe still have some value. But in general, the equity market is overvalued. The bond market we've talked about is dramatically overvalued. The high yield market is terrifying to me. It's yielding less than the rate of inflation. Real estate is priced off of these low rates, so that's extremely overvalued. So in terms of allocating my capital, there's really not a lot of places in the market that I can see value. I wish that to be the case, but I don't see it right now. The bond market, equity market, all those markets, I wish I had more opportunity. I saw some opportunity in the old oil market again, right before the Pfizer vaccine came out, when oil hit zero. I thought that was a good place to start dipping my toe in the water. You had similar negativity on oil, saying that we're never going to use oil again. All cars are going to be electric. There's some cool things happening in the oil space from an investor perspective, in the sense that capital is being cut off. The industry's become a bit of a pariah. So many pension funds and private equity funds are refusing to invest in oil. So you have a backdrop where demand is improving as the economy has recovered. The ability of the industry to finance itself is being severely constrained due to politics and people saying we don't want to support the carbon economy. But the reality is, no matter how much the politicians wave their hands and show you their 10, 20, 30-year plan, many of their projections for the timeline for electric vehicles to come into mainstream use are completely realistic. And if you look at the supply chain for the metals required to do that, it's completely realistic. So a politician's plan and reality are very, very different things. So I think oil is going to be with us for a lot longer than people think. And you're cutting off its lifeblood, both through permitting, politics, cash flow. Nobody wants to invest in the sector. It's had a huge rebound. I just missed that window. I was getting really engaged to get fully invested in oil stocks again. But I still think thematically that's an industry that's capital starved, that's hated, that has a much better outlook than the consensus. That's what I look for as an investor. And the rest of the market is overhyped. Consensus estimates are way too high for the future, and they're not pricing in any of the risks. So to me, oil was one area where I felt there may be an opportunity again, especially in a sell-off if it gets crushed, which it probably will because it's an economically sensitive sector. That could be an area that could provide a significant amount of opportunity, because again, my viewpoint is significantly different in the markets on that, and there's no capital available for that industry.
So you also mentioned, let's say, the electrification and the electric vehicle revolution, let's say. So do you find that copper at this time is also interesting to you, or do you think that market has gotten a little bit ahead of itself?
I think the softness in the overall gold and metals market has sort of spilled into the copper market a little bit. So yeah, I do see an opportunity in the copper market. I mean, copper's had a nice move. It's trading at above $4. So there's a nice pricing, I think justifiably so, because again, I said, if these politicians' dreams come anywhere close to reality and they're able to execute, which they typically aren't, but if they are, you're going to need a heck of a lot of copper to fund this electric grid revolution that the politicians want to put in place. So I see a real strong thematic backdrop for copper in the next 5, 10 years, similar that I see for gold. There's been dramatic underinvestment in the copper space, like the gold sector, for the last 5 to 10 years. So the quality projects are few and far between. And the significant copper producers that you have globally, especially in Latin America, are going through a period of real turmoil now, where there's a real nationalistic, excess profit tax or nationalization talk on a lot of these countries' mining operations, which is going to severely impair foreign investment in those countries until those issues are resolved, the questions are resolved. So your traditional sources of supply are in doubt in terms of these powerful copper producing countries. The pipeline is pretty bare, and therefore the market copper price is sending a signal to explorers and developers that, hey, we're going to need a heck of a lot more copper the next 5, 10 years. Let us give you a price signal that will allow yourselves to finance and bring on new supply. So yes, the backdrop is good. I would say in general, the copper space hasn't gone parabolic. It hasn't gone crazy. So there's still value in the equities. There's still some projects that I think are highly likely to get built that are not trading at valuations like that would be commensurate with that type of project. So yeah, I think there's still some decent value and opportunity in the copper space, and this little pullback in the gold market, metals market, is providing you an umbrella opportunity maybe to add some names in the copper space as well.
Interesting. So would you mind sharing with us how you think about structuring your portfolio, Michael? Do you allocate a certain percentage to explorers that are speculative plays while diversifying the risk by investing in producers?
Yes and no. I'm a bottom-up institutional investor, so every investment I write is an individual ticket or an individual thesis. It has to stand on its own legs. But I have obviously different criteria for the explorers and junior explorers, the higher risky ones, than I have for a producer or physical gold bullion, obviously. So the way my portfolio is structured currently, it's about 5-10% in physical gold and silver. It's about 30 to 40% in producers, and about 30 to 40% in junior explorer, early stage exploration companies. So I can go through each bucket for you if you like. So the exploration companies, what I look for is a sector that's littered with failure. I mean, even if you're a great geologist and a great capital raiser, 9 times out of 10, you're not going to find a mine, and your story is going to be worthless. So that's your viewers have to know that right off the bat. So 9 out of 10 or more, probably 95 out of 100, or maybe 99 out of 100 is the norm. Failure is the norm in exploration. Most stories do not become mines. So I try to take my institutional background of 20 plus years institutional kind of approach to investing and apply that to the exploration sector. And I used to invest in producers for 15 to 20 years. So I know sort of what characteristics a producing mine has. And I've tried to apply that to the really early stage exploration companies and eliminate as many as possible, as quickly as possible. So I look for companies that have a high likelihood of getting built. What do you need? You need grade. Grade is king. Grade is your margin. If your grade is good, you're going to have a good chance to get built. You need a location. It doesn't have to be, Ontario or Quebec or somewhere where you really feel comfortable, but a location where building a mine is possible. So good jurisdiction where you have political support, community support to build a mine. You want to have favorable economics. So CapEx needs to be reasonably low, and the return on the investment for the producer that's going to build that mine has to be quite high. And that comes to grade, the quality of the grade. And I really want to see exploration sizzle. I want to see potential that there's already a mine potentially here, but there's potential with more drilling. This could be very, very large. So you're expanding your mine life, increasing your cash flows. And then finally, I want to see a management team that's both capable geologically and importantly, capable capital markets team as well. So you have to have good geologists there that understand how to build a mine, find a mine, explore for a mine, and also someone who understands how to finance the company strategically to make sure shareholders actually make money out of the exercise. If those all are there, that makes me comfortable on the exploration front. On the producer side, they're producing cash flows. I like small 1 to 2 mine asset producers that have a high likelihood of getting taken out. So they've crossed lexicon, they're now in production. And I say, is this an asset that a larger producer would covet in their portfolio? And is there a chance of a takeover? I don't buy for takeovers, but I look for quality assets that larger producers would want to own. Either A, it gets recognized in the market and trades at a value that producers can't pay because it's too expensive, or B, if the stock gets too low, a producer will step in and acquire the company. So that's the second bucket I look for. But again, I'm a generalist investor. I'd be very happy not to have 100% of my portfolio in gold if I saw huge opportunities elsewhere in the market. But in the gold market and the precious metals market, that's how I'm sort of allocating my portfolio these days.
Mm-hmm. So just to let's say re-highlight or underline something that I remember you saying before is that you can't or you're focused on the asset itself, and you can always replace management, you can always tweak things here or there, but you really want to see that grade and that proper profile of a particular geology of an asset, so that you are comfortable investing in it, right?
Yeah, I'd say that the one-liner I've used, you can't change geology, right? Mother Nature is Mother Nature. What's below the ground cannot be changed, no matter how hard you work and how much effort you put in. You can't change geology. So the geology has to be sound. And that being said, changing management is a lot more difficult than you think, and bad management can destroy a lot of value really, really quickly. So if I find a great project with great geology and great geologists, but a project that may be lacking the capital markets and business acumen to make that great geology and great geology team wildly successful financially, that's a lot easier to change. So that's what I've said before. If you have an openness in the team where they understand there's a deficiency in their management structure or they're on their board, and they want to bring in that business acumen to really make a great project and a great geological team financially successful, that's my perfect setup. Mm-hmm. But going into a project where there's a great project with entrenched management that doesn't want to do the right thing or doesn't care about shareholders, that has to be a really special project for me to want to get involved, because that's a heck of a lot of work to remove entrenched management. So I'm looking for management teams that understand they're lacking something, maybe with a few tweaks to their plan, their capital market strategy, they can have dramatic success. That's my ideal setup. Or even better, finding a team that ticks all the boxes already, where you have great geology team or geologists, and already a very solid, strong capital market strategy. But because of a bear market or negative sentiment in the market, you can get into that company at a great valuation, make significant investment, where you're not forced to make a lot of changes because the recipe for success is already present.
So the last time we spoke, we talked about M&A activity. So why do you think takeouts and mergers have been in a bit of a lull for the past 2 or 3 years here? And do you try to identify targets like this to invest in?
I do. I'll say why it's been a lull. I think COVID's been a big issue. Site visits have been very, very difficult in a lot of jurisdictions to pull off. So reason one is site visits are key. So I think when site visits are more easily available and easier to complete, we'll see an uptick in M&A. More recently, I think what's happened is, like I said, this huge dichotomy between the price of gold and the gold stocks themselves, the producers typically acquire with cash and stock, but typically they'll use their stock to acquire. And when your stock is trading at huge discounts to the perceived fair value, it's harder to do a $1 billion acquisition when your stock is trading at 52-week low for no reason other than sentiment in the market. So I think as the gold stocks recover, as the gold price recovers and these stocks regain momentum, a lot of these deals that have sort of been in the background, discussions going on for a couple of years, you'll be able to do a site visit. The senior producers paper, their stock price will recover. They'll have more currency to be able to do deals and more appetite in the market to fund them. I think you'll see a big uptick in M&A. I think there's a lot of deals that are sort of on the 10-yard line, to use a football analogy, in the red zone, so to speak, that have been sort of stuck there for the last year and a half. That'll become unglued as both COVID and the market starts to rebound. I think you're going to see a big wave of M&A. And why? Because these producers have done nothing on the exploration side for the last 5-10 years. Their cupboards are bare. They're profitable. They're paying dividends. They're paying cash flow. But if they want to sustain those cash flow and dividends into the future, they're going to have to rebuild their pipeline. And the attractive part for the producers is that the explorers are trading at very, very low valuations and they're not getting credit in the market. So it's actually an ideal time for producers to pick up some really quality assets at really reasonable valuations. So I think you're going to see a huge wave of M&A late this year into next year, especially as those bottlenecks are removed.
So, Michael, as we're speaking here at the right tail end of August, do you foresee a good amount of momentum to come back into the space now that everybody is coming back from their, let's say, summer vacation and this real seasonality lull period for gold that typically happens in the summer? Do you foresee money and excitement coming back into the gold space from, let's say, now till November?
Absolutely. I'm putting my old institutional manager's hat on. The summer is a bit of doldrums. People are on vacation. The market gets quiet. You come back to your desk, back to school, September 5th, September 6th, and you're like, how am I going to make money between now and year end? What's the big theme going into year end? And more importantly, how do I want to start positioning my portfolio for 2022? So I think that's a big part of my call right here. The gold equities being extremely attractive. You're a PM. You look at we went through my relative call, but how relatively attractive gold is to the overall versus the overall market. So you see huge relative value there, and institutional investors are very focused on that typically. And then also how the fundamentals are so strong, both cash flow, dividends, earnings growth perspective. So I think you're going to probably see a lot of institutional money managers starting to dip their toe in the water and position themselves for what they think is going to work in 2022. And so you'll start to see that probably accelerate September into December, and really later in the year, December, January, as they start to pre-position their portfolios for the new calendar year. I think gold's going to look really, really good on the relative basis, and you're going to see more interest in the sector as people get back to work in the fall.
Excellent. So, do you ever look at any uranium plays as well? I know that you speak to a couple of people in the industry that are very interested in uranium, and I want to know if that fits into your thinking around this let's say commodity bull cycle as well.
Yeah, I think it's a good call on uranium. Similarly to my call on oil, I think you're going to need a lot more uranium electricity generated production from nuclear energy and both oil than the green kind of agenda thinks in the coming 10 to 20 years. So I think the backdrop for uranium demand is very, very strong. So I think that's a great place to start in a commodity. The issue I've had with the uranium space is I don't want to say it's uninvestable, but it's very hard to invest in it because and it's probably a reason why I think the uranium sector is going to do so well. There are so few producers of uranium that are publicly traded that are quality producers. And then when you go down the junior exploration space, there's very little. I try to find mines as early on as possible in their life cycle, and the uranium junior exploration product is a bit the Wild West. Like the failure rate's going to be really, really high there. Although those junior exploration stocks in the uranium space will do really, really well, but they'll do really well on the back of the uranium price increasing, and not because they actually ever have a chance to become a mine. And that's just that's more speculation. That's more a game that I'm not very comfortable playing, is investing in stocks that I know potentially are worthless, but they're going to go up in value 4, 5, 10 times because of a thematic trade. Mm-hmm. I typically leave that to others. It's not my strength. So yeah, I think the uranium backdrop is strong. I think demand is strong. But other than Cameco and a few handful of ways to play it, there aren't really many legitimate junior explorers that you can play, and there aren't many legitimate producers you can play. Whereas the gold market and the copper market has a lot of breadth of names, a lot of opportunity, a lot of stuff can get forgotten about or not followed properly and get misdiagnosed or misvalued. So that's where I see more opportunity in the gold and copper space. But the uranium thesis is a valid one in my opinion.
Excellent, Michael. Do you have anything you'd like to add or any thoughts you'd like to share with us before we wrap up here?
I think we covered a lot of ground. I just think it's a really opportune time to be engaging in the gold sector. be greedy when others are fearful. I think right now, no one in the market is fearful. And I think there's a lot of fear in the gold market. And I think that's a really compelling opportunity for investors to pick up some great bargains here in the market in the gold equity side of things.
Absolutely. Some sound perspective there, Michael. Thanks so much for your time today. Really appreciate it.
Thanks, Tom. My pleasure.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.